A very good afternoon, ladies and gentlemen. Welcome to the 17th of November weekly market review. I can't believe it that we are past the halfway mark of the November month already. And of course, today we have with us back, now I can say the award winning of the investment blog of the year, Mr. Gerald Wong. How has your weekend been?
It has actually been very busy. So I was in Brunei last Friday and over the weekend, just to share some investment education talk as well. So day after came back to Singapore, had a short rest and had to start preparing for the week ahead once again.
Yes, talking about that trip to Brunei, I saw your social media update. That was a very insightful sharing. I think you should share it in one of the sessions with our CS members as well. But then back to the topic of today, I think for the weekly market review, we saw that STI hit an all-time high again last week on Thursday, even though the US market did have some pullbacks on concerns of whether we will see a rate cut next week or whether it's Donald Trump is saying something that can be detrimental to the markets again. But then again, on the Singapore side, being the steady and of course the growing market with the a lot of initiative coming up, we see the SIA result as well as Singtel last week. So I think Gerald will bring us through the details today.
Sure. Okay, the disclaimer before we start, the sharing is not tailored to your individual investment objectives and risk appetite and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. It'll be of great help to the SIAS team. And if you'd like to join SIAS as a member, do scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources and investor education programs. So in the past week, we saw mixed performance across the global markets. The S&P 500 was about flat, but in here we saw that there was divergence in terms of the share price performance. The tech stocks, as reflected in the Nasdaq, was down by 0.5%, with the concerns about the AI spending as well as overstretched valuations. In Singapore, like Sunny mentioned, we saw the Straits Times Index reaching new all-time highs, driven by positive earnings that were reported by a few companies. So the key news that came out in the past week was really various Fed officials commenting that the December rate cut may be far from certain. So that actually diminished investor hopes of a upcoming rate cut. And with that, we have seen a bounce in US government bond yields. The US 10-year government bond yield is now back to 4.15%, after dipping below 4% in late October. If I were to look at the US 1-year government bond yield, also bouncing to about 3.71%, having came down to about 3.55% in late October. So we see here that based on the latest CME FedWatch tool, investors have moderated their expectations of a rate cut for the upcoming meeting in December. In fact, now more than 50% probability that we will see the rate being kept at the current level. So that is a significant change over the past month. If I were to compare across the past month, just 1 month ago, close to 90% probability that we will see a rate cut in December, but now that's come down to below 50%. So in terms of the performance of the STI, I mentioned earlier that we saw the STI reaching new highs. We have here Singtel actually being one of the top performers after they reported their latest earnings. In terms of the worst performers, we have some of the REITs here, probably reflecting the higher government bond yields. So I'll start with an update on Singtel, given that the share price has reached new all-time highs, $4.86 versus about $3 at the start of the year. So in terms of the profit announced by Singtel, we see here that the company's underlying profit actually went up by 14% to 1.35 billion. Okay, the reported net profit was up significantly because of some of the divestment gains. But if I were to look at the underlying earnings, that was very strong as well. What is driving this strong growth in underlying profit? We can look at some of the key drivers of Singtel's earnings. So we start with two of the key businesses in Australia as well as in Singapore. In Australia, we see here that Optus saw an increase in the operating profit to 283 million Australian dollars in the first half of the fiscal year for Singtel. In Singapore, despite the competition, the operating profit for Singtel in Singapore remained stable as they were able to cut some costs to be able to offset the weakness in the consumer business. If I were to look at some of the growth businesses for Singtel, NCS actually saw a 41% year-on-year growth in the operating profit to 184 million. That was driven by contributions across a few of the different segments within NCS, and they also secured new orders within the first half of the fiscal year. Next, if I were to look at digital infraco, that also saw healthy customer demand and renewals, which led to an increase in the operating profit by 6% year-on-year. Next, we come to the regional associates. Here, we see that the regional associates profit after tax increased by 12% year-on-year, driven by two key geographies. One is India, where we see Airtel having a 68% increase in the contribution. And next, we also have AIS having a stronger contribution towards Singtel. Okay, so with the stronger profit, Singtel has announced an increase in the interim dividend. That would include the interim dividend, of which core is at 6.4 cents versus the core of 5.6 cents in the previous year. We also have an interim value realization dividend of 1.8 cents versus the 1.4 cents in the previous year. So with this, the core payout ratio would represent 78% of the first half fiscal year 26 underlying net profit. At the same time, Singtel has still the value realization share buyback, which is yet to be executed. Okay, so Singtel has announced various capital recycling initiatives. They are targeting 9 billion of asset recycling in the medium term, and of which assets recycled since FY24 is at 5.6 billion. More recently, they sold a 0.8% stake in Airtel for 1.5 billion to various institutional investors, and that was done on the 7th of November 2025. Okay, looking into the rest of the year, they seem to be on track to be meeting their FY26 guidance and outlook. So for the first half of the year, the operating company's operating profit growth was at 13% year-on-year. And with that, they are now expecting that for the full year, the operating profit will grow by high single digit to low double digit. Okay. And at the same time, the regional associates dividends is expected to be now at 1.1 billion because of the strong contributions that we already see in the first half of the year. Okay, so that is a nutshell about Singtel. What is driving the very strong share price of Singtel? Really, the growth in terms of the underlying net profit, as well as the increase in dividends that has been announced. Next, we'll come to SIA. Effectively, we have seen the share price coming down slightly after the earnings, even though they have also reported increase in terms of the dividends to shareholders. Okay, so what we see here as a quick summary, the revenue across the group was up by about 2% year on year. That is largely driven by the passenger flown revenue, while the cargo revenue came down slightly. Expenditure grew about 2% year on year, and that is effectively driven by an increase in the non-fuel cost. Okay, so we see here, like I mentioned earlier, in the first half of fiscal year 2526, which is the 6 months ending September, the total revenue grew by 1.9% year on year. The total expenditure increased by 2% year on year. And with that, they were still able to maintain the operating profit at about flat compared to the previous year. But as we saw in the headlines, the net profit came down sharply, representing a 68% decline in the first half of the fiscal year, largely driven by the losses at the associate level. Okay, so this is the group revenue. We saw that in the first half of the year, that increased by 2% year on year. If I were to look at the operating statistics for the passenger side, what we saw is that the passenger volumes as well as yields remain healthy compared to the previous year. Okay, cargo, what we saw here is that the yields came down slightly compared to the previous year due to some competitive pressure, and that actually led to the decline in the cargo revenues. I mentioned earlier the group expenditure went up year on year, largely driven by an increase in the non-fuel expenditure. So that actually went up to about 3.2 billion versus 3.1 billion in the previous year. Okay, so with that, they were still able to keep the operating profit at about flat compared to the previous year, with the revenue going up slightly, but also the operating expenses going up slightly. However, we see here that the net profit came down fairly significantly, and that actually was what was reported in the headlines, where we see here that in the first half of the year, the net profit came down by 68% year on year. So what is driving this decline in the net profit? We can see the bridge in terms of the net profit here. So I mentioned earlier that the operating profit was slightly higher. But what actually changed and brought down the net profit is that the interest expense actually increased. So that brought down the net profit. And at the same time, there was an increase in the losses of associated companies. And this largely came through from their holdings in Air India. So with that, we saw SIA's net profit coming down 68% in the first half of the year. Okay, what is also worth noting is that we have seen the gearing levels of SIA come down. So the debt to equity ratio is now at 0.7 times as of 30th September 2025 versus 0.82 times as of March 2025. So with that, SIA has announced a proposed capital return plan where they intend to pay out a special dividend package of 10 cents per share annually over the next 3 financial years, and that will amount to about 0.9 billion over the 3 years. So that largely reflects the improved financial position that they are in, including the lower gearing ratio that I mentioned earlier. So as first part of this package, they have announced an interim special dividend of 3 cents to be paid on 23rd December 2025. And the second tranche of 7 cents will be subject to shareholder approval at the AGM in 2026. Okay, so what we see here would be the announcement for SIA in a summary. So they have an interim dividend of 5 cents, an interim special dividend of 3 cents, and that will be paid on 23rd December 2025. So in all, a mixed set of earnings for SIA. At the group level, the earnings are still fairly stable if I look at the passenger volumes as well as the cargo volumes. But then the group net profit was put down by the losses at the associate. But as a silver lining, they have announced this capital return plan, including the upcoming special dividend to be paid out. So that effectively will come to the end of the earnings season in Singapore. We have seen some of the companies reporting positive surprises, including names such as DBS, OCBC, and Singtel, which has helped to lift their share prices, as well as the STI to new all-time highs. So coming up, we will be looking at NVIDIA earnings, which will be announced on the 19th of November. And we also have an upcoming 6-month Singapore T-bill auction on the 20th of November. So with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, for the updates on some of the crucial earnings on the Singapore side that we saw last week, SIA and Singtel, which saw some contrasting performance due to their associates in the business. Okay, so my opinion is SIA might be exposed to the Air India associates, which is not profit making at this moment. So once that is resolved, SIA stocks could have a big rebound next year. And of course, SIA also had to navigate some geopolitical risks as well in air travel compared to Singtel, which is a much more stable stock. So with the asset renewal and the value realizations dividends, that could be something that more conservative and stable investors would want to look out for. Okay, so with that, as Gerald mentioned, we have come to the end of the earnings seasons on the Singapore side. Majority of companies have announced their results already, and that has pushed STI to a new all-time high last Thursday at 4,575 points. So with the conclusion of the earnings season, there has also been analyst upgradings of a certain target price for some of the big stocks on the STI index. And the last check that I have seen on Bloomberg, the Bloomberg consensus estimate for the STI index is now at 4,780 points. So if you are investing into the index ETF itself, that could be one of the targets, 4,780 points that you want to look out for. But what happened last week at the end of it was last Friday, we saw a pullback, which is not a surprise because we have come to the end of the earnings seasons. A lot of catalysts that is pushing out the market has come to an end. And that Friday pullback, I believe, was due to mostly profit taking, not any key concerns that we should be worrying about. This Monday morning, we also saw STI sort of pull back about 9 points or down 0.2%. So not too much of a worry. We should be looking ahead to the next quarter, the next earnings results that is coming up. Okay. So on the STI index, resistance level now stands at the upper bound of the Bollinger Band at 4,582 points in the near term. The key support level coming in between the 20 days and the 50 days moving average now at 4,466 points and 4,394 points. Okay, so I will round it off that around the 4,005 to the 4,400 level. That could be the key support level that investors should be looking at if you are getting into the STI index via the ETF. Why is this region a key support level? If you have noted this period over here at the end of October, when we sort of tested the 20 days moving average, you can see between this region, STI rebounded, okay, for the next leg higher. Similarly, in the mid of October period, we also saw the same pattern happening. It broke below the 20 days moving average and then rebounded on the 50 days moving average and pushed the index higher again. So that was also seen on the end of September as well. So this is a pattern that has been sort of a showing up in the STI index. But like what most technical analysts say is the history doesn't repeat itself, but usually rhythm. So this is the rhythm that you should be following on the STI index if you are looking back into investing in the broad-based index. So on the indicator wise, you can see that the MACD, the moving average convergence divergence indicator, the uptrend momentum in the past two trading sessions at least has been getting weaker. So the MACD line is sort of a converging towards the signal line, telling us that we could be at the sort of the tail end of the rally that we have been seeing so far in the past few weeks. Okay, so even though the rally might be coming to an end, it does not mean that the index will go down, but likely it will be supported by these two key moving averages, 20 and 50 days, and might go into a sort of inch-bound kind of formation in the next few weeks, okay, with little catalysts supporting it. On the RSI, you can see that the latest reading at 65 points is still a healthy reading, although it came back down from last week reading high of about the 75-point reading. So it is supported by the moving average, the 14 days moving average on the RSI as well at the 64-point level. So telling us that there could be still a bit of a uptrend momentum in the STI index, but the big jump or the big growth that we've seen in the past few weeks may not be appearing anytime soon. And if let's say the STI touch some resistance level above the 4,580 point level, you should take some profit and wait for a pullback towards the 20 days and the 50 days moving average. Okay, that's the Singapore side of things. Next, let's move to the US indices. So I think the key concerns about the US index is in the past few weeks or up to a month, I would say we have a lack of macroeconomic data due to the US government shutdown. But the good news is that has officially ended after Trump signed the order to fully reopen the US market. So we will be getting some of the key economic data back on the US side as well. So with that, that could bring some surprises because we have not been having this data for a month or two, I would say. And then these key indicators could largely or greatly swing some of the projections that we have ahead, including the Fed cut decision, which is now around the 50-50 level. Okay. So the Dow Jones Index pulled back on Thursday after these concerns. And then after that on Friday, it sort of stabilized around the 20 days moving average, okay, which is around the 47,296 point level. The all-time high now stands at this level over here. Just let me mark it down at the 48,431 points level for the Dow Jones Index. Now, we also saw some kind of rotation out from the tech stock, which is reflected in the Dow Jones Index and into the S&P 500, or even more prominently, the Dow Jones Index as well, which caused the run-up in early part of last week, okay? So that is a key sort of a trend that you might want to look out for if you're trading into the top 30 stocks in the US, which is the Dow Jones Index. So resistance stands at the all-time high, 48,431 points, upper bound of the Bollinger Band at 48,124 points. So the 48,000 handle would be a strong resistance level to look out for after last Friday closing at 47,147 points. Support level will be coming in at the 50 days moving average, now at the 46,611 points level, and could be finding confluence with the low bound of the Bollinger Band at 46,467 points. So the 46,500 level will be a key support level to watch out for the Dow Jones Index, okay? And then we're looking at the indicators. The MACD has turned negative. That means that we could be going into a downtrend, okay, or a technical pullback, I would say. So that means that there's more chance of the Dow Jones Index pulling back further towards the 50 days moving average or the lower bound of the Bollinger Band. The RSI has also came down from last week high of 67-point reading on last Wednesday. It has now is now sitting just above the 50-point level reading, which is the neutral level of the RSI index. If we go lower, that means that there will be more downtrend pressure. But usually when in the past few occasions when we see the Dow Jones Index test this 50-point neutral mark on the RSI, there's usually some kind of a rebound coming in, as what we've seen in the October period over here, as well as the August period over here as well. So this could be an opportunity for me. My opinion now is we would likely see some kind of a bounce at the 46,500 level due to the support level that I mentioned over here, okay? Next, let's move to the broader index, the S&P 500. okay, which also experienced quite a bit of a pullback. Month to date, for the first 2 weeks of November, we are still negative for the month. We have also triggered some key support level on the S&P 500 index already, mainly the 50 days moving average at 6,704 points, and then the lower bound of the Bollinger Band at 6,672 points. So the closing above these two key level last Friday is a key sort of a key significance to traders to see where the market will be heading next. For me, I believe this is the support level. We should see a technical rebound at least towards the upper bound of the Bollinger Band at 6,916 points. Okay, that is the 7,000 handle that we need to watch out for. Okay, which will see very strong resistance again. Okay, so the MACD definitely has gone pretty negative on the S&P 500 index over the past week, and that means that we could see further downside, okay, from the S&P 500 index. The RSI has also breached below the 50-point neutral mark. That means that it could signal weaker uptrend momentum that is present now in the broad index, and hence could experience further pullback. Okay, so investors looking at S&P 500, I would suggest you using the lower bound of the Bollinger Band at 6,672, or even the 6,500 100 days moving average to get back in. So anything below the lower bound of the Bollinger Band could be the opportunity that you could be looking out for. Okay, so as of now, we are still inside that Bollinger Band, above the lower bound of the Bollinger Band and above the 50 days moving average. So everything is looking at stabilizing the pullback that we experienced the last 2 days, at least. Next, let's move to the tech-heavy Nasdaq Composite Index. So we had that pullback on Wednesday and Thursday. Of course, the continued concerns about the valuations of the AI stocks. And of course, I think what pulled back most of the growth stocks in the US market last week was the Fed officials' comments that the rate cut in February wasn't certain and may look unlikely. Okay, so that caused growth stocks and tech stocks to pull back quite a bit. So the Nasdaq Composite Index closed at 22,900, with the 50 days moving average at 22,835 points, and the global the Bollinger Band 595 points. So both of these levels were again tested last week on the Nasdaq Composite Index, and we closed above that. That is a sign that we are not experiencing a very big sort of a pullback over here. So largely the past few months of uptrend would likely be still intact, because we haven't seen a sort of a formation of a lower low, okay, among the major US indices. So the rebound this week will be crucial to see whether the uptrend continues, and some of the responsibility of catalysts will lies in Wednesday announcement after market of the NVIDIA earnings. Okay, so MACD has been negative for the past 1 week, so that is signaling that there could be further downtrend in the Nasdaq Composite Index. The RSI has also gone below the 50-point level, now at 46-point reading. So that means that downward pressure is on the Nasdaq Composite Index. So on the safer side, you might want to reference the 100 days moving average in amber at 21,950 points, or the 22,000 handle to get back in on the Nasdaq Composite Index. Else, the low bound of the Bollinger Band at 22,595 points would be your first support level to look at for the Nasdaq Composite Index, given that we closed above that level last Friday. Okay, so these are the updates I have on the technical side on the major indices. Anything else you'll be looking out for, Gerald?
I think for this week, it is really about the NVIDIA earnings, given the correction that we have seen in some of the tech stocks with the concerns about the AI spending. This will provide us with signals as to whether those concerns are valid or not.
Yes, so with that big earnings coming up on Wednesday, NVIDIA, I do hope that everyone will trade safe, stay informed of what is happening in the market. And of course, we will continue to be updating you here on Weekly Market Review as well. So I think that's all the time that we have this week. We'll see you again on next Monday, the next Weekly Market Review. So have a good trading week ahead. Goodbye.